Have you ever wondered how to outperform the stock market, even if you lack insider knowledge and don't have a quantum computer at your disposal? Well, you're in the right place. Joel Greenblatt's The Little Book That Still Beats the Market is like the cheat code for the financial game. Stay tuned because in this video, I'll not only reveal Joel's exact magic formula to outperform the market, but I'll also provide step-by-step instructions on how to effectively apply the magic formula, enabling you to significantly boost your stock market performance over the long haul. The magic formula. In his book, Greenblatt introduces us to his magic formula for investing success. The author explains that the best way to beat the market is to buy good companies at bargain prices, and he defines a good company as one with a high return on capital, or ROC. In simple terms, ROC is a measure of how efficiently a company is using its resources to generate profits. It is a financial ratio that measures a company's profitability relative to the amount of capital it employs, and it is calculated by dividing a company's net income by its total capital. A higher ROC indicates that a company is more efficient at generating profits than a company with a lower ROC. The author also defines bargain prices as a company's stock price that is selling below the company's intrinsic value, which is the value of the company's future cash flows. Greenblatt's magic formula is based on two financial ratios: return on capital and earnings yield. This ratio measures the return that an investor can expect to receive by buying a company's stock. It is calculated by dividing the company's earnings per share by its stock price. Greenblatt argues that companies with high ROCs and high earnings yields are good companies at bargain prices. He recommends that investors buy the 20 to 30 stocks with the highest combined ROC and earnings yield each year. Greenblatt has back-tested the magic formula over many years and found that it has consistently outperformed the market. For example, from 1988 to 2009, the magic formula portfolio returned an average of 18.6% per year, while the S&P 500 returned an average of 10.6% per year. Greenblatt's magic formula is a popular investment strategy among value investors. It is a simple and effective way to identify good companies at bargain prices. If you appreciate the effort we put into making these videos, a like and a subscription would be the best way to show your support. Picking winners. Think of it as a dating game where you want to swipe right on the attractive stocks and swipe left on the duds. Greenblatt provides more detailed instructions on how to implement the magic formula in your own investment portfolio. Here are some of the key lessons from the third chapter of the book. Choose a time frame. Greenblatt recommends that investors rebalance their portfolios once a year. This means selling the stocks that have performed the worst and buying more of the stocks that have performed the best. Screen for stocks. Greenblatt recommends that investors use a stock screener to find stocks that meet the magic formula criteria. There are a number of different stock screeners available, both free and paid. Calculate the ROC and earnings yield for each stock. Greenblatt provides formulas for calculating ROC and earnings yield in the book. You can also use a stock screener to calculate these ratios for you. Rank the stocks by their combined ROC and earnings yield. Once you have calculated the return on capital and earnings yield for each stock, rank the stocks by their combined score. Buy the top 20 to 30 stocks. Greenblatt recommends that investors buy the top 20 to 30 stocks in the magic formula ranking. This will help to diversify your portfolio and reduce your risk. And here are some additional tips for achieving best results. Don't try to time the market. Greenblatt recommends that investors buy and hold the magic formula stocks for the long term. Don't try to time the market by selling your stocks when the market is high and buying them back when the market is low. Don't panic sell. When the market takes a downturn, it's important to stay calm and avoid panic selling your stocks. Remember that the magic formula is a long-term investment strategy. Be contrarian. Value investors are often contrarians, meaning that they are willing to buy stocks when most other investors are selling them and sell stocks when most other investors are buying them. This is because value investors believe that the market often misprices stocks and that they can profit by buying stocks that are undervalued and selling stocks that are overvalued. Be patient. It takes time for the market to recognize the value of your holdings. Value investors need to be patient and willing to hold their stocks for the long term. Greenblatt also discusses the importance of having a margin of safety in your investments. A margin of safety is the difference between the intrinsic value of a stock and its current market price. Value investors always look for stocks that have a large margin of safety. This helps to reduce their risk and increase their chances of profit. Focus on the fundamentals. Value investors focus on the fundamentals of a business, such as its earnings, cash flow, and debt levels. They don't try to time the market or predict short-term stock movements. Don't chase performance. One of the biggest mistakes that investors make is chasing performance. They buy stocks that have performed well recently, hoping that they will continue to do well in the future. However, this is a recipe for disaster. Past performance is not a guarantee of future results. Don't sell your winners too early. One of the best ways to make money in the stock market is to let your winners run. However, many investors sell their winners too early, locking in their gains but missing out on even bigger profits. Don't buy stocks you don't understand. Many investors buy stocks without understanding the businesses that they are investing in. This is a dangerous mistake. Investors should only invest in businesses that they understand well. Don't over-diversify. Many investors believe that they need to diversify their portfolios by investing in hundreds or even thousands of different stocks. However, over-diversification can lead to underperformance. Investors are better off investing in a few high-quality stocks than in a large number of mediocre stocks. Navigating market volatility. What to do when you're right, but the market is wrong. One of the biggest challenges that value investors face is that they can be right about a stock, but the market can still be wrong for a long time. This can be frustrating and discouraging, but it is important to remember that value investing is a long-term game. It takes time for the market to recognize the value of your holdings. This is because the stock market is volatile and there are many factors that can affect stock prices in the short term. Making the formula work. The magic formula has outperformed the S&P 500 over the long term, but it is important to note that the magic formula is not a perfect investment strategy. It has experienced periods of underperformance in the past. However, over the long term, the magic formula has proven to be a successful investment strategy. I would also add that the magic formula is just one tool that investors can use to find undervalued stocks. There are many other factors that investors should consider when making investment decisions. One of the best ways to build wealth over time is to invest regularly. This means investing a fixed amount of money at regular intervals, such as monthly or quarterly. The magic formula is a simple but effective investment strategy. By following the tips above, you can increase your chances of success using this strategy. So be realistic about the expectations of the magic formula and to use it in conjunction with other investment strategies. It is important to note that value investing is not without risk. Like any type of investing, there is always the potential to lose money. However, over the long term, value investing has proven to be a successful investment strategy. And there you have it. We've unraveled the mystery behind the little book that still beats the market. Thank you for tuning in, and remember, the only way to become a financial wizard is to keep learning. Leave your comments, questions, and thoughts below, and let's keep the conversation going. Until next time, happy investing.